The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. I'm Carolyn Roth with Juliana Tattlebaum and Dan Murphy in Davos, and these are your headlines. President Trump takes aim at the Federal Reserve, pushing the S&P 500 to a record high as he called for borrowing costs to be swiftly lowered, claiming he knows more about interest rates than Jerome Powell. The Bank of Japan lifts rates to their highest level since 2008 and signals further hikes are in play.
Plus, Europe comes under fire from President Trump, claiming the U.S. is treated, quote, very unfairly by the bloc as a senior EU official downplays the risk of a trade war.
In my opinion, neither Europe nor the US are interested in a trade war, and at the same time, businesses, politicians and citizens would all notice it.
And Givaudan tops full-year sales expectations and says it will most likely beat the top end of its four-year growth target. We'll speak to CEO Gilles Andrier next hour.
Good morning, everyone. Yes, we have a lot to talk about today. TGIF, good morning to Juliana.
TGIF, for sure. It's great to be here and a lot to digest this morning.
And the big news, a plethora of comments really coming from Donald Trump last night. Let's get through some of the commentary here. Donald Trump delivering a pugilistic video address to Davos, covering topics ranging from interest rates to European regulation in his first major appearance at an international event since his return to the presidency. Trump targeted Fed President Jerome Powell, saying he will demand that interest rates drop immediately. He also doubled down on threats to impose tariffs and said his administration would do something about America's trade deficit with the European Union. Also under fire, of course, the price of oil, with Trump saying he would ask OPEC to bring it down, and defense spending, which the president said NATO countries should hike to 5% of GDP. Now, of course, at a forum known for its focus on globalization, Trump emphasized his administration's shift to trade protectionism.
My message to every business in the world is very simple. Come make your product in America, and we will give you among the lowest taxes of any nation on earth. We're bringing them down very substantially, even from the original Trump tax cuts. But if you don't make your product in America, which is your prerogative, then very simply you will have to pay a tariff, differing amounts, but a tariff which will direct hundreds of billions of dollars and even trillions of dollars into our treasury to strengthen our economy and pay down debt. Under the Trump administration, there will be no better place on earth to create jobs, build factories, or grow a company than right here in the good old USA.
Now, Juliana, what is it? Is it day 5 into a second term? And of course, this was to be expected. No one is going to be surprised by these type of comments, neither the investment community nor Powell himself. He's heard it all before during the first term, in the run-up to Trump's second term. And this is exactly what we should be expecting from Trump. A whole lot of volatility, a whole lot of sort of off-the-cuff comments, and his stream of consciousness, which makes it onto the airwaves. And he's criticized Jay Powell before. Obviously, what the Fed is going to be focusing on when they meet next week is not just this. This is just noise. This is, of course, what they're used to. But obviously, the tax cuts, the tariffs, Trump's stance on immigration. But I think what they'll also have to focus on is the market rates and how they've shot up, the long-term borrowing costs, while at the same time they've lowered interest rates by 100 basis points. So there's so much to think about next week, not just Trump's comments, right?
For sure. I mean, also, as you say, Jay Powell is no stranger to criticism from the president. He faced all of this during his first term as president. To me, when I listened to those comments, it was really a warning, not only to Jerome Powell, but to Europe, to OPEC, to Russia, to the U.S. banks, and it was calling out all of the individuals, very Trump style, but really using this forum to send a warning to all these different bodies. The other thing that really stuck out to me, beyond this being a warning to those groups, was the absence of China. And this was a theme at Davos as well among the business community relative to past years, and certainly relative to the campaign trail and to Trump's first term. China was not a central piece of this address. And you think about the last 5 days in office, and Trump has really refrained from antagonizing China in the way that we saw the first time round. He has gone ahead and delayed the ban of TikTok. We're talking now about the imposition of 10% tariffs on China, not 60% like we were hearing during the campaign. So it feels as though he is setting a more conciliatory backdrop. What is the long game here for Trump with regards to China? We'll have to wait and see. But it was a notable absence, I would say, from the morning yesterday.
This is exactly why we've seen a more positive tone on the markets, because the expectation was that we're going to be seeing 60% tariffs on China and very, very tough tariffs on the rest of the world. And now it seems he's softening up a little bit. And this is really injecting some positivity in the markets, and risk has been back on for the last 5 or 6 trading days. Now, you can find our write-up of the key points from Trump's speech on the CNBC website. And Juliana, while you and I have been talking about Trump, a little bit of M&A action in the European banking space, the Italian lender Monte dei Paschi launching a bid to acquire Mediobanca. Once again, the Italian lender Monte dei Paschi, as had been reported by Bloomberg this morning on Friday, launching a bid to acquire all the shares of investment bank Mediobanca for 15.92 euros per share. MPS launching that voluntary public exchange offer for Mediobanca for 13.3 billion. The offer is expected to be completed by the third quarter of 2025. They're saying that this will be a double-digit accretion on adjusted EPS. The new group to accelerate usage of 2.9 billion euro DTA over 6 years. So more consolidation in the banking space in Italy. And this might drive forward the idea of the European Banking Union. So how are the markets taking Trump comments?
Well, let's take a look at the U.S. trade, Carolyn, and what we saw yesterday. It was more green for Wall Street. The U.S. market rallying for the 4th day in a row. We're talking about the Dow, the S&P, and the Nasdaq all moving higher. As you can see on your screens there, the S&P gained about 0.5%, hitting another intraday high. The tech-heavy Nasdaq lagged a little bit, but still gained 0.2%. It is now up about 2% on the week. And the Dow Industrials also moved higher to the tune of about 0.9%. All 11 sectors in the market were positive in the session. Healthcare was the leader stateside, while tech was the laggard, interestingly, but still ended the day in the green. Now, moving on to bond markets. This is the picture for treasuries. You can see yields moving lower across the curve there. The U.S. 2-year currently trading around 4.26% or so, and the 30-year trading about 4.8%. As for the overnight trade, here's the picture in Asia. A lot of focus on Japan, and we're going to dive into that market in more detail in just a moment. But here's the overall picture. Nikkei 225 up 9 basis points. Over in Hong Kong, that market rallying hard overnight, 2% higher. The Shanghai Composite and the Kospi also moving higher. But back to Japan. Caroline, talk us through what we heard from the BOJ.
Absolutely. The Bank of Japan has hiked rates by 25 basis points, lifting the benchmark rate to 0.5%, its highest level since 2008. Quick check of Japanese markets this morning. The Nikkei 225 higher by just a smidgen, and we're seeing dollar yen changing hands at $155.26, just a touch weaker against the yen here in response to that widely expected hike. Lin joins us with more. Lin, that we're going to move to the upside. They had this hawkish tilt back in December, but they refrained from hiking back then. Why were the conditions right this time?
Hey, Carolyn. Well, as far as what the Bank of Japan has been telling us, and mind you, this decision, as you say, widely expected, widely telegraphed, and basically what they focused on were 2 things. The first was in relation to the wages outlook here. That was one of the reasons given as to why they refrained from moving in December. And since then, even though wages talks actually only officially kicked off this week, that they feel feel that they've been receiving some positive anecdotal evidence, particularly in terms of the BOJ regional economic report, which is equivalent to sort of the Fed beige book, that they're hearing sort of these optimism coming through in terms of wages growth being able to match or potentially even be higher than what we saw last year. And then in terms of the other element here, this was very much the US President Trump element that they wanted to see basically after he was inaugurated, whether or not there would be some major shocks to the market, and particularly on the tariff and trade front. And I guess on that front, we didn't get those immediate tariffs as many had expected. Certainly it sounds like we will be getting tariffs, but he's really using it as a bargaining chip. And so because of that, actually because of really some of the announcements in relation to AI, we've actually seen a little bit of euphoria in terms of the markets as well. So that kind of explains why we got this decision today, this 25 basis point hike. But, you know, we've been talking to economists as well, breaking down this decision. And as a number of economists out of Tokyo are telling us that whilst it's not written in the monetary policy statement itself, that really they moved this month because they're worried about the currency. After they decided to hold in December, and then Ueda, if you'll remember, on Christmas Day, gave some comments that sounded pretty dovish as well. We saw that dollar yen was moving closer to that 160 level, and we're seeing inflation accelerating, but a lot of it, guys, coming from the cost push element.
Lin, thank you so much for breaking down the decision for us. We're going to continue the conversation here in studio with David Mitchinson, partner at Zenor Asset Management. David, great to see you this morning.
Good morning.
So the BOJ has surprised us a few times before. This time round, the move highly anticipated. My first question to you, anything surprising in today's decision?
I think the move itself, hiking rates by 25 basis points, moving rates to the highest level for 17 years, wasn't a surprise. The market was very well prepared for this. Probably the surprising factor was the commentary from the BOJ showing that they had significantly increased confidence in the durability of their inflation and the growth rate in Japan. We had kind of this core CPI was more than 3, but the sort of the prices that consumers are facing is going up about 3.5%, 3.4%. You know, for the BOJ, this is something that I guess that they have been trying to achieve, but they are clearly overachieving at the moment. But it's that durability that they're really focused on.
The BOJ had signaled that they were waiting to assess the broader economic climate post Trump's inauguration before making a move, given the uncertainty around his presidency. How much visibility do you think that the Bank of Japan really has and the Japanese economy more broadly to what happens? And how sensitive is the Japanese economy to what happens on a global level?
I think if you step back, you know, the BOJ has, over the last 35 years, quite a long time frame, has hiked rates a couple of times. They've killed off a recovery a couple of times. They've been trying for at least 20 years to try and generate a sustainable, moderate level of inflation. I think today's data shows they think that they've just about got there. They're going to be very, very data dependent. I think they'd be willing to be behind the curve, but they don't want to be too far behind the curve. So they have to grapple with both Trump and also they've got to battle with the Japanese political cycle.
David, let me pick you up on that. Everyone knows the BOJ is behind the curve. They know it themselves in terms of normalizing policy. Are they speeding up too much? And are they breaking things as they normalize rates?
I don't see any sense that they're breaking things in Japan at the moment. I mean, rates are only 50 basis points. It's not exactly tight monetary policy. They're running real rates of at least negative, 2. Most people believe that at a minimum rate should be around about 1%, probably higher. So there's definitely a sense that policy is still very accommodative.
But this is not an economy that's booming. This is not an economy that can withstand any hike. Consumer confidence is still on the softer side. And the big question is, as these higher wages come through, are they actually going to spend it, or will they all just save it?
So if you look at Japan at the moment, actually the economy is very much a kind of two-track economy. There are areas that are absolutely booming. So if you're in central Tokyo, there is no sense that this economy is not booming. If you were to go to Niseko, the ski resort, that is absolutely booming. You go to Kyoto, you can hardly move.
Isn't it? That's the weak yen, that's the strong dollar, no?
It is, but central Tokyo is doing very well. People have been making very serious money in Japan. So you do have this group of people in IT, maybe in finance, entrepreneurs who are doing very, very well. But there's also a big swathe of the broad population who are not. So it's the BOJ is trying to grapple with this change.
How much influence or how much can the BOJ actually control the transmission mechanism, and whether these interest rate changes actually facilitate, or make their way through the broader economy and not just these central cities that you mentioned?
I think what the Bank of Japan, what the government, frankly, what the population want is growth in real wages.
Yeah.
Last year, for the first time really since the bubble economy in the late 80s, we saw that happening. This year, the sense is that we'll probably see another year of real wage growth. That's really the government's core focus. And if they can achieve that, then they'll feel that they have more scope to raise interest rates.
You mentioned the Japanese political cycle being a factor here. Expand on that.
So the current government doesn't have a controlling majority in the Diet. They're going to have to hold elections later this year. And they would like, obviously, to go into that with a much stronger economy, the sense of momentum. And at the moment, they don't have that. So they're obviously looking for that, real wages to continue to grow and for a better outcome.
A quick one, David, before we let you go. You like Japanese equities. A lot of people have liked Japanese equities over the last 2 years. It's been one of the stellar performers when it comes to the Asian trading or to the Asian space. But this is not necessarily linked to the weaker yen, which might not be so weak going forward. What is it linked to, and what sectors do you like?
So the most exciting story in Japan is the corporate governance reform. This was kicked off a decade ago, but it's now really beginning to bear fruit. The stock exchange, the government, companies are all pushing very, very hard to drive this governance reform. And that's causing companies to restructure themselves, deploy capital in different ways, treat shareholders better. And that's one reason that people are so interested in Japan.
David, great to have your time this morning. David Mitchinson, partner at Center Asset Management. Juliana, what's coming up on the show?
Well, it is a packed one for you. Trump isn't being cryptic about his feelings toward crypto as he signs an executive order promoting the currencies. We'll bring you the latest this hour. Plus, Dan is still up in the mountains in Davos as the World Economic Forum wraps up. We'll bring you interviews from the CEOs of Shein, Fresenius, and S4 Capital. And that is not all. Earnings season continues. We'll be speaking to Ericsson CEO Borja Ekholm on a first on CNBC interview. That is coming up at 6:45 GMT. Welcome back to Squawk Box. U.S. President Donald Trump has criticized the trade relationship between the EU and U.S., saying the bloc treats his country, quote, very, very unfairly, very badly. Speaking in his virtual Davos address, Trump vowed to take action on what he sees as an unequal relationship, echoing his comments in December that the EU would face tariffs. Stéphane Séjourné, the European Commission's Executive Vice President for Prosperity and Industrial Strategy, admits Europe needs to change its mindset if it wants to become more competitive, adding that he's made it his duty to help foster a more pro-business environment. Séjourné sat down with Karen at the World Economic Forum at Davos and discussed the EU's competitiveness in the fields of AI, international investment, and first green technology.
In
the short term, this could have an impact on the economy, but in the long term, it's a political mistake. First of all, because it won't boost businesses involved in the transition, which have already embarked on. In 10 years' time, Europe could be proud having clean industry and services and businesses at the cutting edge of technology, thanks to their ambitious targets. I don't want to deregulate. I really want to simplify things. So we're going to keep our climate targets, but we're going to streamline red tape and administrative frameworks. That means removing certain management reporting and standards and organising the Commission around business support and not just regulation, as was the case before.
I want to bring up the massive investment that is coming stateside. Stargate, it's been called $500 billion in investment over 4 years to build out AI infrastructure in the United States. If we weigh up how much is being attracted to Europe at this stage, how much is being pledged by the European Commission, it doesn't feel like it's anywhere near what the US is targeting. How far behind is Europe when it comes to AI infrastructure?
We have a target, which can be found in the Draghi report, to invest $800 billion into the European economy to catch up with the US in competitiveness and productivity. In reality, AI and tech are tools of productivity for our businesses. We'll catch up with the certain unicorns and companies at the cutting edge of technology here in Europe. We have to help them to grow, to scale up, which is a real problem in Europe. And so we're going to create a European competitive edge, which will allow all the businesses to have a regulatory environment and appropriate financing to stay in the race on a global level. I met the CEO of Mistral just now, who has very bold ambitions on both a European and a global level. These are the types of business we have to help grow and also to protect in Europe. So it will be a case of Europe first for AI, and we won't be abandoning this promising sector, which is the industry of the future.
If we're talking about technology names, is it right for Europe to think about a different mindset, almost a Mark Zuckerberg-like mindset, to go fast and break things?
The European mindset has already changed a great deal with this new Commission. So we obviously want this simplified regulatory environment, but we also wish for Europe to be an attractive region for the international investment and for the global tech. For that to happen, we have certainly simplified things, but we've also provided visibility. Europe has a competitive factor today due to the rule of law, stability, predictability, and it provides an environment which businesses appreciate, such as quality universities, workforce, and a high quality of life. So to keep our competitive edge, we have to change the mindset of Europeans and those politicians responsible for this. At the Commission, I'm one of those really pushing for a more pro-business environment.
All right, let's get to some corporate earnings. Signify posted 6.1 billion euros in sales for 2024, with operational profitability at just under 10%. The lighting firm launched a share buyback program and announced CEO Eric Rondolat will step down after this year's annual general meeting. Eric Rondolat, the CEO of Signify, joins us now. Thank you so much for your time. Eric, let me just ask you directly, was it your decision to leave the company after 9 years at the helm, or why did the board think now was the right time to change leadership?
Good early morning, Caroline. Look, if Steve was there, he would tell you that 9 years ago, we were discussing with him when we IPO'd the company, but I've been managing Philips Lighting and then Signify for now more than 13 years. 2024 was a very important year of transition where I needed to be present because we implemented a substantial restructuring plan aiming at saving 200 million on our structure cost. And this is a very successful program that we have launched. So I needed to be there. But then we discussed with the board, and we looked at the new era that is coming in front of us. The company is much stronger than it used to be in the past years, and certainly much stronger at the end of 24 than at the beginning. And we believe jointly that it is the right time to make a move. In my mind, I think that change always brings opportunities, for the company to get a new leader for the coming 5 to 10 years, which was certainly far beyond any timeline for me after 13 years at the helm of the company. While at the same time, it's also an opportunity for me to do something different. So at the end of the day, it was a discussion with the board. We're very, very close, and we believe that's the right thing to do, and that's the right moment to do it.
All right, Eric, thank you so much for clarifying that. Obviously, you talk about the challenges facing the company, the professional business, the business in China. So how quickly will the new leadership be able to tackle that? What are the key points here to address?
Well, if you take some distance and you understand how Signify operates, we have a business which is structurally declining. That's the conventional business. Now, the impact in 24 is about 240 basis points on the top line and 40 basis points on the bottom line. This also means, as we were stable from a profit margin at 9.9, slightly below 10, as you've described it, it means that the other businesses, our consumer business and our connected business, were able to compensate that drag. Now, the team is led by very capable people who have been performing, over the years. Our board is now launching a replacement process, and they will look at internal and potentially external candidates. But I stay until the AGM at the end of April. I think we will see clearer at that point in time, and I'm very confident that the team is well equipped to continue, and that the board will find a suitable replacement, in the coming month.
Eric, good morning. Let me dive into two of the challenge areas, and Carolyn mentioned them just a moment ago, China and the professional business in Europe. These have been longstanding issues for Signify. Firstly, on China, is it a question of the China market being soft overall, or are these company-specific issues that you're facing?
Again, this is Juliana. Hi, Juliana. Look, China has been a difficult market, not only for Signify, in the past year. And yes, we've been commenting on it because especially the consumer part of the business for Signify is quite depending on China, which is a very important market, a very large population, and it has a higher proportion on our overall consumer business than the professional part. So it's primarily linked to the situation in the Chinese market. On the consumer side, people have a lot of savings, but they are not spending as much as they used to. And on the professional side of the market, some of the issues in the real estate, and we are very dependent on the construction non-residential. So the market was slow, but we adapted. The top line went down, but we were very resilient when it comes to the profitability. And as far as Europe is concerned, it's not a long-standing issue. It has been an issue at the end of the first quarter of 2024. Once again, it's not only Signify, it's the overall market. We saw a weak market in Germany, which is the biggest economy of Europe, also in UK, also in Eastern Europe. On the contrary, and it's very interesting to see that the northern part of Europe was quite dynamic. So a very, very, very different and heterogeneous part on the different economies of Europe, but it's not a long-standing issue. It has been only for 24.
Okay, fair enough. So 2024 issue, good context there. Eric, lastly, for your successor, when they come in, what is your message around tariffs and how well positioned or how insulated or not is the business from potential tariffs coming into play in the next over the next few years with the Trump presidency?
So first, we've been trained because we went through a first wave of tariffs, a few years ago. And we know how to do it. When those tariffs were put in place, we could mitigate all the impact with two major actions: footprint on one hand and increasing prices. Now, when I look at the China imports on our US market, is basically less than 20%. So if tariffs are voted, we're going to be able to compensate that part. When it comes to Mexico and Canada, I think our footprint is very similar to the footprint of the industry. So we believe we're going to be able to do whatever's required whenever we know what's happening, because as you have seen at this point in time, there's still a lot of speculation. So we really want to talk when things are concrete, and we're going to talk about concrete actions, but we are pretty confident that we're going to be able to mitigate, whatever tariffs are being put in place with footprint adjustment and optimizations, and potentially also price increases.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.